So welcome everyone to our webinar on maximising small business growth for the new financial year. My name is Bianca Reynolds and I am a practice leader in our corporate team here at LegalVision, and my co-host is David Rosenthal, practice lead at Retinue. Welcome, David.
Thank you, Bianca. It's great to be here and good morning, everyone.
Wonderful. So before we begin, a couple of quick housekeeping items. So you'll receive the recording and the slides in your email address. Please submit your questions in the Q&A box and we'll endeavour to answer them at the end of the webinar. And you'll also receive a feedback survey following the webinar as well, and we'd appreciate if you could please complete that too. And for the next 48 hours, you're eligible for a free consultation with LegalVision to discuss how we can help you and your business. So please fill in your contact details in that survey in order to claim your consultation. So today we will be discussing a number of things. So firstly, business structures and tax efficient business structures, commercial contracts, conquering cash flow, employment policies, planning for the 3Ds, protecting your brand, tax concessions for startups, and then of course questions at the end as well. So I'll begin the webinar today by speaking about business structures. So in Australia, the most common business structures for startups and small businesses are sole traders, so a single business owner and operator that owns the business, partnership, where the business is jointly owned by two or more partners, so that can be individuals or companies, trusts, a company, which is a separate legal entity that has shareholders who are the owners of the company, and then directors who control and manage the business owned by the company. And finally, a trust structure where you have a trustee that owns the assets of the business for the benefit of the beneficiaries of the trust. And that trustee can be an individual or a company as well. So when you're thinking about business structures from a legal perspective, really consider what your business plans are, for this new financial year. Are you going to be working with others, looking to bring on investors, operating nationally and expanding, or even internationally? And also thinking about what type of industry you operate in and what the risk is in terms of your business operations. Are you operating in a highly regulated industry where the risk of liability is high? So these are some of the key things to think about when you're deciding what structure is going to be best for you. So in particular, liability is a big point to consider. So sole traders and partnerships where they're involving individuals generally offer more unlimited liability, whereas companies offer more limited liability protection, particularly from your personal assets, which can be separated out from the assets of the business. So if you do operate in a high risk industry, then limiting your personal liability through a business structure that's appropriate is going to be important for you. The next consideration to think about is the ease of raising capital. So companies often find it easier to secure funding than sole traders and partnerships because they can attract investment and issue equity, shares in exchange for that investment. Whereas sole traders and partnerships really rely on personal contributions to the business and also funding through, obtaining a loan from a bank, for example. So for this reason, companies can usually scale more efficiently because of their ability to raise capital and attract investors in that way. And finally, another structure to think about this year for you is a dual company structure, where you would have a holding company which owns the valuable intellectual property and other important assets of the business. And then you would have an operating company, and that's the entity that actually runs the business day to day, enters into contracts with customers and employees. And in that way, the assets of the business in the holding company are separated out and protected from the operational liabilities of the business which sit in the operating company. So this is a really great structure for startups or small businesses who do have valuable intellectual property, such as source code, or those who do operate in highly regulated industries that involve more risk to help you protect those assets. It's also a great structure for growth because it's attractive to investors so that they can ensure their investment is protected in the company that owns the assets compared to the one that actually incurs the day-to-day risk in the business. So now I'll hand over to David to talk about some of the tax considerations that are relevant for these structures.
Fantastic. Thanks, Bianca. So talking with our four main structures, I want to kind of talk a little bit about, what are the tax benefits and using each one. So starting off with a sole trader, one of the advantages is you have a marginal tax rate. So a sole trader gets taxed at their personal marginal tax rate. And an advantage of that is obviously if you're starting off in business, you'll pay the least amount of tax because you have your tax-free threshold, plus you have just the marginal tax rates. And because we're in the new financial year with the stage 3 tax cuts have just kicked in for individuals. So you actually have a bit of an extra tax saving there. So a good rule of thumb is when is it worthwhile to restructure out of a sole trader because you're paying more tax than other structures. The rule of thumb number is normally about $120,000 of profit. So if you're a business and your income is over 120,000, it's a good time to review whether that structure is right for you because there are more tax efficient structures out there. One of the advantages with a sole trader as well is the losses can offset other income. So let's just say you are employed and you start a side hustle business, you're just building up, you're not ready to go full time into the business yet. Potentially, as you're starting up that business, it might generate some losses because, you're building up, you don't have that income base yet. You can potentially use the loss from your business to offset your employment income or any other income for that matter, which can help save you some tax overall and get a bit more cash flow in. Now, there are conditions that apply to it. One of the main things is the business or your side hustle has to have at least $20,000 of income. So if you're not generating that level of income, you can't use those losses. They get lost, what we call defer losses. So then the next stage up on the sort of structure pyramid, we've got the partnership. And with a partnership, the advantage is, once again, you have the partner's marginal tax rates. So obviously a partnership doesn't pay tax. What happens is whatever happens in the partnership, it gets split two ways. So 50-50, if you make $100, each partner takes $50 income and they pay tax on that at their marginal rate. So once again, one of the advantages is you don't just have one marginal rate, you have two marginal rates now. So if both of you aren't earning any income, but the partnership earns around $40,000, $20,000 goes to you each, and you won't be paying tax on $40,000, which is a bit of an advantage. One of the unique things with a partnership is the loss can offset a partner's personal income as well. So if the partnership lost money, that partnership loss goes to both the partners, 50-50, and you can offset that against your employment income as well. And there's no conditions applied to that. So that's a better advantage of using a partnership. Then we move on to our companies. So our company, one of the great things is you have a flat tax rate. So for most businesses, active businesses, the tax rate is a flat 25%. If you have more of an investment holding company, you might be paying a tax rate of 30%. So the rule of thumb, the law is if 80% of the income of that business is generated from passive sources, being, rental property, share income, things like that, it can potentially pay a tax rate of 30% instead of 25%. So that's something you obviously got to consider as well when you have multiple companies and how they're structured. One of the also advantages is you can retain the profit and distribute it when it's more tax effective. What that means is let's say, for instance, I made $150,000, had a really good year. As a sole trader, I have to pay tax on the whole $150,000, regardless of whether I need all that money or not. Maybe I only live on 50,000 because I'm frugal. But the company will pay a flat rate of tax on the 150,000. And let's just say I took the 50,000 for myself as a wage. I only pay tax on that 50,000. The remaining money stays in the business and I can take it out at a future date. So it can be a good tax planning strategy if you leave the profits in there, if you don't need them, to sort of bank them and take them out maybe when you're making less money as more of a retirement exit strategy. And then finally, we have a trust. So a trust is a flow-through entity. It doesn't pay any tax. It manages assets on behalf of the beneficiaries, whether it's business or a family. And the trustee has the ability to flexibly distribute the income between beneficiaries. Let's say I had a business and I made $100 or $100,000. I have the ability to distribute how I want. So maybe I'm going to give Bianca $90,000 this year and I'll keep 10,000 to myself. But then the following year, I might do 50-50 between me and Bianca. And then the year after that, I might do 70,000 to me and 30. I have complete discretion to distribute that income how I see fit. So you have the ability to flex it between tax efficient structures, whether you have another company or other things like that. So a lot of people always ask me, what's the right structure? There's no one right structure. You always got to, as Bianca said, weigh up between asset protection and from my end, there's tax minimization. So you always got to play with those two and really get the advice and get it right from the start. So I'll move on to the next section with Bianca.
Great. Thanks so much, David. So the next thing we'll talk about is commercial contracts. And so as you look to grow your business this year, it's really important to think about what are the essential commercial contracts that you want to have in place to protect your business moving forward. So things like trying to ensure certainty of payment, certainty of products or services that you rely on in order to operate your business. And also having dispute resolution frameworks in place if you need them in future. So some of the key documents that we recommend you think about this year are a partnership or a shareholders agreement, depending on your business structure. So these documents are really important to define the relationship between the business partners or the shareholders if you operate as a company. So it will set out things like what are the decision-making processes, what are the dispute resolution mechanisms if you can't agree on something. So these are really critical as the business grows. So you have these mechanisms in place in the event that things might not go to plan. At least you've got a really clear framework on how to resolve those issues. And terms and conditions are really essential if you are a business that is providing products or services to clients, customers. It makes it really clear if you are providing a software service that you've got terms outlining how your users can use your software or your platform. It ensures that it's clear what those services are, how you are to be paid and when payment is required. And again, if the customer doesn't pay or if there's some other issue, what's the dispute resolution process going to be? So really key to have these in place to protect your business. A few other kind of common contracts that we do recommend you think about are, firstly, confidentiality agreements, so also called non-disclosure agreements. So these are documents that you want to put in place if you're discussing, potential collaborations with, other players in the industry or other potential service providers that you want to collaborate with. And so these will protect your sensitive business information, your trade secrets and intellectual property, so that you can then look at developing those discussions further and knowing that your information is protected. Lease agreements, so these are really important, if you operate a shop front or if you have an office location for your business, provide certainty about what your tenure at that premises is going to be. You've got certainty of rental payments and also any rental review processes so that you can plan for the future, know the term of your lease at that location, and also for cost certainty for these expenses. And a couple of other documents here. So supply agreements are really key if you, receive specific products that you use in your business. So it's important to have these in place to secure reliable and cost-effective supply chains. So these should outline, the terms of delivery, quality standards for the products that you rely on. Again, payment terms are really important. And then service agreements, again, if you outsource key functions, having those clear terms of service, performance standards, and also payment terms and dispute resolution processes as well. So the most important thing is really just thinking about how you can secure consistent and reliable delivery of products and services to your business that you need, but of course also payment from customers and clients that you work with. So I'll hand back to David now to speak a bit about cash flow.
Thank you, Bianca. I've always been taught this saying as an accountant, and it still rings true today. Sales is vanity, profit is sanity, but cash flow is king and queen. And the number one reason why businesses fail is because of poor cash flow. And the number one creditor who they always owe money to is the ATO. Time and time again, every business always, wherever they fail, it's because they don't manage their cash flow properly, and it's always the ATO who gets last paid. Now, at last check, the ATO, small business owes the ATO around $50 billion in outstanding GST and pay-as-you-go withholding. So there is a lot of money out there, and I know a lot of businesses are feeling that sort of crunch right now with this sort of in our economic climate. Every business I know that has survived and thrived, these are the sort of key 8 points which we always discuss and we focus on, and this helps them get ahead. So the number one is know your magic number. And I always tell my clients time and time again, if there's anything you ever remember from this, it's definitely remember, what is your magic number? The magic number is the number you need to put a roof over your head, put food on the table, and have quality of life. So once you understand what your magic number is, then you can build a budget based off that magic number. So if you need $5,000 a month to live, that's great. Let's build a budget to see how you can get that $5,000 a month. So we're going to build up, fantastic. Then do you need to make $20,000 of sales and have $15,000 of expenses to make that $5,000 of profit? So the building block starts from the magic number. Then you can build a model or a budget of how you can build up from there. So then you know where you're going and you know how to achieve that. Next up, review your terms and conditions. So obviously speak to the great people, LegalVision, make sure you get your terms and conditions right, and consider progress payments. Now, for the people who are in sort of very transactional businesses, supermarkets, cafes, things like that, you don't have progress payments because you get paid when things happen. But if you're in a project-based business, consider getting regular payments when work is completed, because I've been there before and I've seen businesses who hold off billing to right at the end of a 6-month project, only for that customer to actually go into liquidation. And then you are out of pocket and you're actually quite behind because you were banking on money coming in. So make sure you have that money, you get the progress payments, because if you don't invoice them, you still have to find that money to live. So you got to work it. So you got to make sure you keep the cash flow going. Review your pricing. Are you making a profit? Remember, as business owners, you don't live off sales, you live off profit. So you need to understand whether you are actually making money or not. And a good rule of thumb is if you're quoting on jobs and you're winning every single job, you're underquoting. Because by default, you should be in a place where probably people think you're a bit, but if you are winning every single job on price, you are underquoting. Next up, review your expenses. Are you across what's going out and your outgoings? It's amazing how many people they sign stuff up, they get new phones, they get subscriptions. You have your Adobe and your Zero, you have all your different subscriptions, and you've realized that you've got this very big lot of money coming out every month. Is that actually adding value to your business? Are your expenses helping you generate more money, or are they just being lost causes? Next, follow up on your debtors. As I said before, with the invoicing and making sure cash flow goes in, have a system in place. Don't let it get out of hand, especially with larger businesses. You need to have a system in place to make sure that you're not relying on very large debtors, because it can get ugly very quickly. And if one goes in liquidation, then you are left with no money trying to basically get ahead. Organize your bank accounts. Every business that succeeds has separate bank accounts for taxes. Has one bank for general business, one bank account for taxes. Help organize everything so you know you're not dipping into your tax payments. And then finally, review major purchases. Do you need that shiny new ute? Do you need the new BMW? Is it going to help generate it? Make sure when you review the major purchases, can you afford it? Because remember, you're going to be paying for that with profit. And if that profit is used to your magic number, you're going to have a bad time. And that's where the issue is. Because ultimately, if you need $10 to live and your business makes $9, you will come into a problem at some point. So those are the key things about understanding cash flow. And if you follow those, it'll help you get ahead, not just to survive, but to thrive. And back to you, Bianca.
Great. Thanks, David. So, following on from cash flow, if you are looking at engaging employees this year as you look to grow your business, that is something that you will need to consider in terms of your ability to hire employees and be paying salaries. So, the first thing that you really need to have a think about when you are looking to bring on employees to grow your business this year is, firstly, documenting your engagement with them, making it really clear what their remuneration is, what their entitlements are, if they're subject to any employment awards, making sure that you're across those so that you know your legal requirements in order to pay them, the minimum wage, for example. And also having a think about including procedures for performance management, probation periods, and things like that in your employment agreements. So it's much better to ensure compliance with employment law upfront, as you're growing, than risk, future claims for unpaid wages or entitlements, down the track. So you are looking to bring on employees and you're thinking about how you can secure top talent this year, if you don't quite have the cash flow to be able to pay market rate salaries. And if you operate your business as a company, you can have a think about employee share option plans or employee share schemes. And this is a way you can remunerate and reward your talent by giving them the opportunity to earn an ownership stake in your company. And that can help to incentivize them as well. Again, if you can't quite afford to pay the salaries that they might otherwise get in the market. So I'll talk through now a few policies that you should consider putting in place from an employment perspective as you grow. So the first is a workplace health and safety policy. Work health and safety applies to all businesses in Australia. So it's important that you're aware of your obligations, that you've got a strong safety culture in your business to protect employees, but also helps you to then enhance productivity if everyone's safe and well. And that can help to reduce any downtime in supporting, your business growth and expansion. A code of conduct is another really important procedure and process, setting out, what do you expect from your employees? What's the standard of behavior that you require? It helps to build your workplace culture, and is crucial for retaining key talent and ensuring that it's consistent across the board for all of your employees. And a few other policies to think about I've just outlined on the slide here. So, anti-discrimination policy to promote diverse talent within your workplace. A positive working environment attracts top talent and helps to retain it. Also thinking about flexible working arrangements, offering remote work, different flexible working hours, particularly if you can't pay market rate salaries, you can have a think about other non-cash benefits that you can offer to your employees, such as these kinds of policies. And then finally, a disciplinary and grievance policy. So you want to make sure you've got key procedures in place for handling any employee misconduct and employee complaints. So you've got those really transparent processes so you can resolve and address any issues head on as you look to kind of bring on more and more people in the business as you grow this year. All right, so I'll hand back to David to talk about planning for the 3Ds.
Thanks, Bianca. Planning for the 3Ds is probably one of the things you will always look at throughout your life. Question is, what are the 3Ds? The 3Ds are death, divorce, and disaster. They're the three things you always got to plan for, because when it happens and you don't plan for it, nothing good will come of it, because everyone will be stressed out and no one really works that through. And it's especially important if you go into business with someone, because you're not just planning for yourself. What happens if your business partner falls under the 3Ds? It's a very scary thing. And I've seen it most of the times in my career where people haven't planned properly and they don't have the tough conversations when things are easy and everyone's happy, because understanding where you're going to when times are tough helps you plan and helps you manage that really stressful emotional time. So these are the key things I've seen in my experience, which helps manage those three things. First off, consider your personal situation. Have you organized your wills, your super, insurances, set a solid foundation? Speak to your lawyer, speak to solicitors, speak to LegalVision. Get everything sorted so they understand, so you understand where they are, and your family knows what's going on as well. Especially if you have a blended family, these things can cause a lot of ructions. So you want to make sure that everyone has an understanding of where assets are going to be distributed in the event of your death. Next up, discuss early. Have the tough conversations. So when you go into business with someone, you should be having these conversations of how you plan this out. One of the key things I always tell people if they go into business together, and it goes into my next point, how do you plan to walk away from it? So you two should be able to sit down and go, how do we plan to walk away from this? Because one person might be looking to build this for the next generation. Some person might be, your business partner might be wanting an early exit in 5 years. You need to have that conversation so you can both walk away with what you want, because if you can't settle then, you've got to question whether it's worthwhile going to business together in the first place. And once again, once you have those questions, definitely get a fantastic document. I recommend it all the time, a shareholders agreement. They're absolutely worth their weight in gold, because essentially they have the finer points of how you are going to work into business with each other. Have a relationship of, do you both need approval to spend more than $10,000? What happens in a dispute? What happens if one wants to sell out? You have those shareholders agreement is really sitting with a lawyer, a solicitor, and having those conversations and formalizing it. So then everyone is on the same page. And during that process, you will work out a dispute resolution process. So what happens if you have a disagreement? What happens in that so you can work it out? Because if you don't have these things in writing, and I have a perfect example of two young fellas going into business together. I told them to get a shareholders agreement for multiple years. And when they actually went through the shareholder agreement process, they actually worked out that they didn't want to be in business with each other. So they actually sold out and walked away. But having that conversation allowed them to do it in a peaceful process. And then finally, one of the key things is about reviewing your insurances. And one of the key things around that is what happens if your business partner passes away. If your business partner passes away, what happens? Because their share of the business would go to the spouse. Spouse would rather the money, you would rather the business. You can get insurance policies to help buy the spouse's out share in the event of death, and it's a buy-sell policy. These things are very key, so that way everyone gets what they want and we can walk away with it. So they're the key things about planning for the 3Ds. And that really works hand in hand with a lawyer. And we would work in tandem to make sure we get the best outcome for you. I'll hand it back off to Bianca to wrap things up.
Right. Thank you, David. So the next point we wanted to cover was about protecting your brand. So, if you're looking to build your brand reputation, you've got a business name or a logo, really important to think about trademarking that name so that you can prevent others from using that name or that logo. It protects your brand identity and helps to ensure that, you remain distinct in the market. If you've got an invention or a unique design as part of your business, have a think about if you can apply for patent protection or design right protection, again, to help prevent others from being able to copy the look of your product and ensure you can maintain that market differentiation. And a few other intellectual property protections here as well. So securing your domain name, making sure that you build a strong online presence for your brand, particularly in this day and age. If you license your IP to others, have a licensing agreement in place, ensure that it's clear how your IP can be used, make sure you have control over that, and developing a comprehensive IP strategy and audit process. It can help you identify assets that you want to protect, ensuring that your brand identity is secure, and also so that you can monitor for any infringements and be prepared to enforce your rights. So we have a trademarks team at LegalVision that can certainly assist with that, and that really helps to protect your brand's reputation as you grow. And so I'll hand back to David now to talk about tax concessions for startups.
Fantastic. Thank you, Bianca. So there are there's four main real key tax concessions for startups. They're quite chunky and they're quite technical. So I'm just going to sort of talk it at a very high level of what's available. But obviously, if you want to delve into it further, you do need to speak with an accountant so to work out if they're right for you. The first one we've got is employee share scheme startup concessions. So in the startup world, one of the key things they help to retain staff is by offering what's called employee shares, or employee share schemes. So part of your remuneration will be paid in shares. What normally in the traditional world, what happens is when you get issued those shares, there's a deemed tax benefit, there's a deemed income amount, and the staff member has to pay tax on that straight away. So if Retinue gave me shares right now of X value, I would have to pay tax on those shares. But I didn't get any cash, which gives me it doesn't make it very nice. And the shares, and the problem is when you're in a startup phase, the shares might not actually be worth that much. So you've got to be careful because you end up getting this sort of sting in the tail of paying tax, but you can't really sell the shares to pay the tax bill. So what they do is they offer eligible startups they offer their shares at a discounted price, and it doesn't trigger tax liabilities for employees until in the future when they're more valuable. So that's one of the advantages for startups to offer these sort of share schemes to retain really key employees. The next one is the R&D tax incentive, which is it's been around for many decades. It's a really good scheme for businesses while they're developing a product. They basically get a tax offset worth 43.5% of the actual R&D expenditure. So that is just pure cash back. And so if you're spending, you'll get 43% of it as cash to help fund the business as it goes on. This is for businesses with turnover under 20 million. It can be quite lucrative, especially with a lot of the sort of, your tech building companies, your software companies, as they're in that startup phase. A lot of them will live off this R&D tax incentive to help get the business going. It's a very technical process. And so really it is a niche thing, which you've got to get the right advice because it is heavily regulated by the ATO and also Oz industry. Then the next two concessions. First off, we have write-off of startup costs. So traditionally when you start up a business, you'll probably get advice. You'll speak to a lawyer, you'll speak to an accountant, and you'll set up all these costs. Now, traditionally, these costs are actually not deductible. They're actually written off over 5 years because they're not in connection with starting up a bit with running a business, because they're starting up a business. They've actually allowed a special condition now where startup costs for advice around the setup and the establishment of the business can be written off straight away. So as opposed to being written off over 5 years, you'll get the deduction when you start up, which is really good for businesses to get going. And then finally, we have the instant asset write-off. This is a fantastic scheme for claiming big deductions when you start up the business. So in traditional accounting land, when you buy a big ticket item, a car or a piece of machinery, you would have to write it off over multiple years. So if I bought an asset for $20,000, previously I'd have to write off $5,000 every year for 4 years. What you can do now is the government allows you, so if it's under $20,000, you can write it off in one big go. So you get a big sugar hit, big tax deduction, which helps pay less tax and helps basically keep that cash flow in to help grow the business more and more. So it's available for any business with under $10 million, which is a great scheme. And it's available right now until the end of 30 June 2025. But generally, they do revisit that and they renew it year on year. So they're the last big tax concessions for startups. But if you want any further questions, obviously contact an accountant to get some further information. I'll hand it back to you, Bianca.
Fantastic. Thanks, David. So that concludes the main part of our webinar today. You might also find our publication useful. It's our startup manual, which is a legal handbook for founders and goes through some of the information we talked about today in more detail, including business structures and raising capital. So we have an upcoming event as well, which you might be interested in for our next webinar. And while we are looking to go through the questions you've submitted today, thank you all so much. While you submit them, we'll just talk a bit about our LegalVision membership. So by becoming a LegalVision member, your business gets unlimited access to our full team of over 100 specialist lawyers who can help with all of your day-to-day business as usual legal needs. So it's really like having a lawyer on your in-house team, for a fraction of the cost. So they can assist with things like unlimited business contract drafting, legal advice consultations, and also unlimited domestic trademark registrations and much more as well. So as a member, you won't have to worry about the cost of lawyers. Think of it as having your own lawyer within your business. We'll take care of all of the business as usual legal work for you, and you can really then just focus on running your business. So to learn more about our membership, please request a free consultation in the survey at the end of the webinar. And if you need any accounting support, you can also contact Retinue at these details. Besson would be happy to discuss this with you and go through how Retinue can help you this year. All right, so now we'll just have a look at some of your questions. So I think just given the timing, we had a lot of tax questions come through, David. So I don't know if you want to start us off by going through some of those.
I'll try and touch off as much as I can. I appreciate, time is of the essence. So I'll try and cover a few of them off. I know there was a couple which was sent in, so I'll try and cover those off as well. Angelica, in that question with 120,000 about change. So the 120,000, when you should start thinking about changing from a sole trader to a company, is that gross income or assessable income? It is what we call, like taxable income. So that's the income you're paying tax on. So if you're paying tax on $120,000, that is when you would consider moving into a different structure. Okay. And now next one. I set up a family, Dale's written in, I've set up a family trust in a company with the IP held by me personally. I'm just thinking a company might be okay. Can I undo the trust very easily? That is really depending on how you'd have to read what's called your trust deed. So Bianca knows her way around trust deeds. And basically, your trust deed will tell you how you can unwind the trust if you need to. So you'd probably speak to the fantastic people at LegalVision, and they can probably offer you some guidance around that. Is there a minimum number of trust beneficiaries required? So Kieran's written this question. There's no minimum number. Like, obviously you have to have one. Every year the trust has to distribute income. So what happens is you're gonna have to distribute the income, or what happens is the trust will actually pay tax the highest marginal rate. So you do have to have, and it could be just yourself. So Kieran, if you wanted to set up a trust, you could have yourself as a beneficiary, and then you would obviously get some fantastic legal advice and work out what other beneficiaries you want to include on that and get updated on that. Is there anything you want to add on that, Bianca, or have I sort of nailed that one?
Yeah, that's right, exactly. So you just need to make sure that if you are an individual trustee, you can't be the sole beneficiary of your trust. So normally there would be different categories of beneficiaries. You might have yourself and also, any children or your spouse, charities, just to make it clear that it's more than just you who can benefit from that trust.
Fantastic. Thank you, Bianca, for clarifying that one. SS. If a service provider, SS has written about sweat equity, offering services in return for equity. Does the service provider have to pay income tax on the value of equity received? Yes. So with that sweat equity, if you're receiving something in return, you are getting some consideration. It is kind of like an employee share scheme. The ATO will deem that as some sort of value. This is where you'd probably get some advice on that employee share scheme concession, which we're discussing. So you would probably speak to account and work out what you're receiving, what you're getting, and the timing of that. But as soon as you inherit a right, like an obligation, once you get that right to have the shares, that would be a taxing point. That's where you would pay tax. So you probably do need to get some advice around that. Probably also, and that's probably a legal advice as well, is when you're getting the equity, what's the contractual basis of that? And we go there. Is that right, Bianca? Is there anything else I'm missing there?
Yeah, that's right. So I just think you need to make sure that you've got a clear contract in place, setting out what the services are, the specific equity you'll receive as well. So yeah, definitely feel free to use that free consultation so you can book in with our team to discuss your specific circumstances in more detail. Um, so look, unfortunately, we did have a lot of questions come through, but that's all the time we have for today. So we do apologize if we didn't get to your question, unless we might have time for one more, David, if there's one that you were itching to answer.
I do have time for one more. I can definitely cover off. I think one of the ones, it was, what's the most tax efficient way to transfer funds from business to a director? There's no right way or wrong way. One of the considerations is generally versus wages versus a dividend. A dividend is an after-tax profit. Wages you get paid during the business. Obviously, the things to consider when you have wages versus dividends. When you pay a wage, it is tax deductible to the business, but the other costs to that are superannuation and workers' comp. You're going to pay that on top of your wage. When you pay a dividend, it's obviously a bit more advantageous because you don't get a tax deduction, but you do get franking credits attached if the company has paid tax on that. One of the other things to consider when you're doing that, whether wages versus dividend, is are you going for home loan or finance? The reason I say that is banks don't look too fondly on dividend income. They prefer wage income. So before you do any sort of remuneration strategy, think about your goals and what you want to do, because if you're going for finance over the next 6 to 12 months, it might be better just to pay yourself a wage to get the home loan, and then you can strategize a bit better.
Wonderful. Thank you, David. So we did have a lot of questions come through. So definitely, if there's something specific you want to discuss, please use that free consultation to go through that with our team, and we can discuss how we can help you in more detail. Um, so you can also learn more about our membership as well as part of that free consultation. And we really do value your feedback. So please complete the 30-second survey at the end of this webinar. So thank you all so much for joining us today. We really appreciate your time, and we hope to speak with you again soon.
Fantastic. Have a lovely week, everyone.